everyone. Welcome to our webinar. Happy 2024 to all of you. I hope your year is off to a good start. We want to go over a number of things today, really looking at investment topics. Fortunately, 2023, hopefully you're aware, was a wonderful year in the markets, which was very pleasant after a not so fun 2022. We're going to recap some topics from 2023 and also talk about items as we look forward into 2024. Before we get moving, I want to introduce Eric Stein, who works with our firm as a consultant on investment matters. He is with East Bay Investment Solutions. So thank you, Eric, for joining us.
Happy to be here. Thank you.
Okay. All right. Without any delay, we'll get started. Of course, every presentation has to start with disclosures. I won't stay here for long, but obviously past performance is never indicative of future results. We can't provide legal or tax advice, etc. So summary of the disclosures, but we'll get into the good stuff. As I mentioned, thankfully, 2023, it was nice to have some positive things again. We'll just go through some of the hot topic numbers for the year. The good news is, despite a lot of anticipation of the economy going into recession in 2023, there were no blips or occurrences of a recession in that year. A not so great topic is that one credit agency did downgrade the U.S. credit rating below AAA, which is the highest rating possible. And that was due to some dysfunction in our government during the year. Inflation, on a positive note, has come down a long way. We capped out at 9.1% several months, about a year back or so. We, as of December, landed down at 3.4%. It's not perfect. It's not where the Fed would like us to be at 2%, but it is a distinct improvement. At the end of the year, on December 31st, the U.S. Treasury, the 10-year Treasury yield was 3.88%. We'll talk about the fact that interest rates have, and yields and interest rates have come up significantly particularly from the ultra rock bottom lows of COVID. In part, interest rates have moved up because the Fed, you're probably aware, has really ratcheted up. The Fed policy rates that ended the year at 5.25% to 5.5%. Again, continuing with a lot of good news, returns were very robust in 2023. International stocks were up 15.6%, and the S&P 500 had a very smashing return of 26.3%. So as we go forward, as always in the markets, there are positive spots and those that, there's always concern or headwinds in the market. On the positive front, to kick off, as we said, it was a wonderful year for investors, and that's despite the fact that there were a lot of headlines that scared individuals, which we'll talk about. And it's also indicates it's really hard to time the markets, because if you look at an ugly headline, if you freak out, you don't want to sell out because it turned out to be a good year. As we said, inflation has continued to recede, and we're hoping for what's called a soft landing in the economy, that we don't move into a recession, and that bonds now offer a lot more income, and more income than we've seen for over about 15 years. On the headwind side in the economy and for the markets, obviously the wars in Ukraine and the Middle East are not a good thing, and there is a risk of expanded tensions around the world. Speaking of tensions, we also have some tensions within our U.S. government that we hope we're going to avert a shutdown this year. We've been kicking the can on that. And it's always possible that inflation could tick up again. I'll just touch upon this quickly and then turn over to Eric that, as I mentioned, you don't want to necessarily react to what's in the headlines. You also don't necessarily want to react into what people are prognosticating. This chart looks at what analysts have forecasted at the beginning of the year of how the S&P will perform in the upcoming year. And what you'll see here is that over each year, the blue line here gives the estimate of how the analysts think the S&P will perform, whereas the yellow or orange bar indicates how the S&P actually did perform. And you'll see that there's pretty big discrepancies, which are outlined here with the arrow marks, that in each year, there was more than a double-digit discrepancy. So, be careful about what you read in the papers. All right, Eric, I'll hand this over to you.
Thanks, Jen. And you'll see a common theme across what Jen has already said and what I'll talk about over the next couple of charts is, again, as Jen said before, it's just really hard to time the market, and it's not something we would recommend you doing. If you look at this chart here, you can see the ups and the downs that occur over the last couple of years in the market. And, if you think you can time when markets are going to go up versus when they're going to go down, good luck, because there's very scant evidence that, professionals who have been doing this for a very long period of time have any ability to do it on a regular and consistent basis with any, positive results. And, we talk about just being and staying invested, throughout the trials and tribulations of the last couple of years. If you had stayed invested in the S&P 500, for example, you would have earned a return of over 33%. Whereas if you just sat in cash, you would have been below 7%. Now, that's not a bad return for sitting in cash per se, but you're certainly going to miss out on the possibility for much greater, higher returns by being in the S&P. So, kind of our theme is stay invested. It's really tough to time the markets, and we just wouldn't recommend trying to do so. And to give you an example, Jen, if you could advance to the next slide.
Yeah, and actually, Eric, I'm going to interject here. I failed to bring up an administrative item at the beginning that we're happy to take questions throughout this webinar. If you do have a question, you can submit it through the Q&A box at the bottom of your screen. So please feel free to do so. Sorry to interrupt.
Yeah, so what this slide is showing, and I'll walk through just some of the colors because it can be a lot when you first look at it. But if you look at the top darkest green line, essentially that is showing from January of last year to the end of last year, and it's in price-only returns. But you'll see the 24% of the S&P 500. Now, again, trying to time the market's very difficult. There's roughly 250 trading days in a year. If you missed the 5 best trading days within last year, your return went from 24% to roughly half at less than 13%. It's a pretty significant drop by just missing 5 days. If you missed the 10 best days, drop down to that, I'll call it that peach line, you had a return of less than 4%. So again, by just missing a handful of days or 2 handfuls of days, your return will dramatically change and be lower if you miss those best days within the market. So again, when do those days occur throughout the year? We don't know. We don't know why they occur. We don't know when they're going to occur. They're just going to happen throughout the year at various times. And it happens pretty much every year. You could do a similar chart like this, where if you miss the best 5 days or best 10 days, your return is significantly lower than if you just stayed invested. So again, theme of this slide, stay invested. If you could advance one, Jen, please. And again, this shows 2023, very similarly, again, lots of ebbs and flows throughout the year. It's certainly not a straight line up, though November, December, were significantly positive returns and was a good chunk of our overall 2023 return. But things just happen throughout the year. Again, these are just a couple of instances of what happened. If we remember back to March of 2023, we had a little bit of a banking crisis where a couple of banks, including Signature Bank, defaulted. Later in the summer, as Jen mentioned, we had Fitch, one of the rating agencies, downgrade U.S. debt. We've had we had the Hamas attack in October. And there are other things that just happen throughout the year. When these things are going to occur, again, we don't know. They're not predictable. They're sort of the unknown unknowns, as they're referred to. We don't know what they're going to be or how impactful they're going to be. So again, our belief is to stay invested. Now, if we talk about international returns, we've spent a lot of time talking about US stock returns, and international equity returns have been quite strong too. If we just look at international large growth and international large value, we have returns of 17.9 and 17.5 as examples. And what's really nice about that is, I'm sorry, just international large cap is 17.9. While it's not as good as, let's say, the S&P, again, I don't think anybody's going to turn away from an almost 18% return in international markets. And we would still recommend diversifying into international markets because, again, there is some diversification benefit, not having all your eggs in one basket. And there are different economies. They have different things that are happening, different political cycles, different events that are occurring, which can cause their returns to be more positive or negative in different times of the year and throughout the years. So again, while the returns may have not been as strong last year, and certainly in some previous years, we still recommend having a chunk of your portfolio allocated to non-US stocks. And here's another reason why as well, is if you look at the valuations, again, this is a little bit of a busy chart, but I'll do my best to explain it. This looks at price to earnings ratio, which is a method, looks at how stocks are valued, to put it quite simply. So if you look at the purple line in each of them, we've got the US on the left, Japan, Europe, emerging markets, and China. You can see how the purple line shows the 25-year average of what that 12-month price to earnings ratio has been for these various markets. And you can see the light blue diamond is where we currently are as of the end of the year. So let's just use the US as an example. The US at 19.5 times, it just means that we are more highly valued. Things are more expensive in the US in terms of stocks than our 25-year average. Whereas if you look at Japan, Europe, emerging markets is roughly similar, and China, you can see that the current valuation is well below the 25-year average. So again, these stocks are undervalued. So when we talk about diversification, we talk about currency exposure, we talk about valuation. These are all potential reasons to include non-US stocks in your allocation. So let's move on to bonds. So Jen mentioned where interest rates have been and where they came from. So if we remember back to where we were in COVID, go back to, if you look on the left-hand chart back to around 2020, you can see that dramatic drop that happened in around March of 2020 when COVID really became a very global event. And the Fed very quickly dropped interest rates to near zero levels. And then if we fast forward to 2022, you can see how that purple line, for example, moved up very rapidly. That's the one-year treasury. And you can see just how that moved up very rapidly in line with what the Fed was doing in increasing interest rates. And corresponding rates somewhat followed what the Fed was doing. So if we remember from, if we think about how sort of bond math works, when we have interest rates going up, our bond prices go down. So, and we had a huge increase in bond yields in 2022, which led to, frankly, the worst bond market in terms of returns in 2022 we've ever seen since they've been tracking bond returns. So if you think about what happened in 2022, this picture pretty much tells it all. In 2023, on the right chart, you can see that returns were much more positive, whether we're looking at treasuries or corporate bonds, short and intermediate, short being 1 to 5 year, intermediate being 5 to 10 year, and even global bonds having returns of over 8%. This came from having higher yields. So, when you have higher yields, as Jen referred to in one of the earlier slides, you also have higher income, which is a real good positive. So, again, if we see bond yields drop, if we see the Fed decrease rates over the next year, you should see an increase in your bond return as well, just coming from that those decreases in bond rates. So if we talk about the Fed as well, what Fed always has what they refer to as a dual mandate, two objectives they're trying to achieve. They're trying to achieve maximum employment, which is a low unemployment rate, or strong employment. And they also want to keep prices stable, which is relatively low inflation, which they define as roughly 2%. So if we look at the orange bar, we can see that we have, CPI, which is the well-known measure of inflation, the Consumer Price Index, how in the summer of 22, we hit, over 9%, 9.1% in inflation. And as Jen alluded to, in December, we were down to a little over 3%. So we've had a pretty dramatic decrease in inflation over time. Still not where the Fed wants to be at 2%, but still much better than 9%. But what's been interesting is how the inflation or the unemployment rate, has stayed relatively flat. According to the data we've seen, there's really never historically been a period of time where we've seen the inflation rate come down as dramatically as it has without seeing some sort of increase in the unemployment rate. There are lots of theories for why the unemployment rate has stayed so low. Some of it is probably due to COVID. Some of it is due to the way unemployment is actually calculated. But the bottom line is the unemployment rate has stayed fairly strong and very low at roughly 3.5%. And if we talk about, again, the Fed again, this just goes to highlight in a very easy way what they were doing in 2022, 2023, for example. So if we go back again to 2022, inflation was rising rapidly. They wanted to fight inflation. The easiest way and really the only way for the Fed to fight inflation is to increase the Fed funds rate, which also increases interest rates in general. So you can see how they increased rates fairly rapidly in 2022, which again led to the very poor bond returns that many of you probably saw during that year. And in 2023, they continued to raise rates through about half the year. And then they did what we refer to as sort of a pause, where they basically said, okay, we want to see how the impact and what the impact of our rate increases have been over the last year or so. And let's just sit back and see what the data is telling us. So since about the summer, they've pretty much held steady with no increases in the Fed funds rate. And the estimates are, at least the consensus estimates are, which again, we know from following them year after year, may or may not prove out, but the consensus estimates are today that we will see at least one decrease in the Fed fund rate in 2024. And again, that remains to be seen, because the expectation was that inflation would continue to drop. But as we saw in December, inflation actually increased very slightly year over year. But it just goes to show that inflation isn't dead. And the Fed doesn't want to sort of prematurely decrease rates without knowing that their fight against inflation is, in their eyes, at least won. So when we talk about sort of what that delicate balancing act of interest rate management is, it's very difficult for where the Fed sits. It's a job that it's just very difficult to balance everything they're trying to do. And if we think about where interest rates are, if you are a saver, if you're a retiree and you're focused on the earnings from your bonds and your fixed income, you want higher interest rates, ideally. That is going to give you more interest income. That's a positive for you. From a Fed perspective, it also helps to reduce inflation. But there is a con to it as well. So if you are buying a car, you're buying a home, you are borrowing anything, your borrowing costs have gone up. We've seen it in mortgage rates. We've seen it in other borrowing costs. Interest rates go up, borrowing costs obviously go up as well. That also impacts the U.S. government debt interest payments. So any debt that we have that we're issuing, we're going to be issuing at higher rates than we've issued in the past. That's also going to cause more interest costs as well. And what the Fed is trying to do is they're trying to balance things. They're trying to say, okay, we want to slow the economy. We don't want too many dollars running around. That causes inflation. But at the same time, if we hit the brakes too hard, if we raise rates too fast, too high, we can slow the economy and push it into a recession. So they're trying to balance it, and that's what Jen referred to before as sort of that soft landing, where they can slow the economy enough that inflation falls, but not too much that they actually cause a recession. Jen, I'll let you take it from here.
Okay. A question that we've been getting frequently, and whenever we get a question from a few people, we assume that other people are asking themselves that question. So we wanted to touch upon it. It is an election year, and a number of people have been questioning, how is that going to impact the markets? Again, we can never tell you for certain, but we can look at history and glean some insight. So what this chart looks at is prior returns going back about 100 years and looking at what the S&P 500 returns were during election years. And you can see the vertical bar at 0%. Everything to the right of that means that there was a positive return in that election year. Everything to the left represents a decline in the economy or in the S&P 500 during that election year. By far, the end result is that there were many more positive years going into an election than negative years. I'll point out that the lowest of the lows was going into the Obama-McCain election. That was, keep in mind, on the heels of the Great Recession in 2008. So that was a standout experience. But the good news is, just because we're going into an election year, it should not be a foregone conclusion that it will derail the markets. Taking a little bit different look into election years, this looks at the outlook for the economy from each party. The red representing the Republican Party, the blue representing the Democratic Party. And what you'll see here is going up to each dotted line, which is where going into an election, what the Republican or the Democrat outlook is on the economy. So you'll see coming out of the Bush administration, the Republican administration, the outlook for the economy was higher than the blue line below. Coming out of the Obama administration, a Democratic administration, the outlook ending that administration was higher on the Democratic side than the Republican expectation going into an election. Same thing reversed coming out of the Trump administration, and then repeat again, at least currently, through the Biden administration. So the moral of the story is, you can listen to the outlooks just like you can listen to the market analysts. But when it comes to politics, it's almost always skewed toward the party who's, potentially vacating office. And we also, oftentimes get the question of, well, which administration does better between the two parties? Which is going to be better for my bottom line in investment portfolios? And this chart looks at the performance of the S&P 500 through each administration, going back to the 1920s. And what you'll see is that it's an upward trend. Now, the Bush administration, again, had a little bit flatter, but again, that was distinctly, when you had the Great Recession hit. But the moral of the story here is, even if an administration that you don't like comes into office, it is not a reason to vacate or dial back on your stock exposure. You should do that relative to your investment needs, your liquidity needs, your risk tolerance. But in terms of, couching that based upon who's in office, historically, that would not have been a good play for you.
Jen, can you go back to the previous slide for a second too, just to make another point? Thank you. So one of the things we heard, and I sitting where I sit, I get to talk to a lot of different advisors and a lot of different clients at the end of the day. And in 08, for example, going into the Obama administration, we heard a lot of people say, I'm a Republican. I am a diehard Republican. I really don't like President Obama. I don't like his policies. I don't think he's going to be a good president. I'm worried about the economy. I'm not going to invest. And we would argue that that's not the right thing to do. And if you look at the average annual return during the 8 years that Obama was president, you would have missed a 16% return had you not invested during that entire 8 year period. Similarly, we heard other people say before the Trump administration, I don't like President Trump. I don't like his policies. I don't like what he stands for. I'm worried about the economy. I don't want to invest when he's president. Essentially the same things we heard 8 years prior. And if you didn't invest during the Trump administration, you would have missed, guess what? A 16% annualized return. So regardless of your feelings on either party, again, our message is to stay invested. And again, while we can't guarantee they'll be positive, all of our data has shown that over time, stock markets go up regardless of the political party that's in power.
Thanks, Eric. Okay, so, dialing forward really on that same, outlook, we think it's always important to maintain a focus on what really matters, not trying to time the markets. Hopefully those who are viewing today know that we are true wealth managers. So we invest and manage money on behalf of clients, but we go many steps further and look at the totality of every client's finances so that all of the decision making and outlook, that they're interwoven under one roof to look at all components. So we do remind clients that financial planning is a process. It's not just a specific endpoint that you're moving towards. That's why our planning is an ongoing process. I think everyone can probably say that if you look in the rear view mirror to 5 years prior, 10 years prior, maybe even 1 year prior, that the current state of your life is probably not exactly where you thought that endpoint would be as of today. And that's why it is a dynamic process. That you need to concentrate on the long term. Obviously you need to manage short term things that are going on in your life, but you have to keep a focus on what your long term goals are and achieving them. And as we talked about, as Eric went over at the beginning, missing out on just 5 or 10 days in the market in a given year can dramatically impact your returns. So you have to remember that trying to time the markets can really move against you, which has been seen in study after study. So if you're trying to work towards your goals, you have to take a long-term focus. We believe in maintaining a disciplined approach. What we talked about this year, you had drops in the market. We had the bank, experience with Signature Bank. The markets did come down. When Fitch downgraded U.S. debt, the markets did come down. But by the end of the year, investors really prospered. So you have to maintain that disciplined approach and not sell out when things are at the bottom. A good mantra is buy when the markets are low and sell when the markets are high. To that end also, you don't want to cherry pick. We have a chart that we look at every year, and it puts the highest performer at the top and the lowest performer at the bottom. And it is never the same across the board. You don't see the top performers stay the same. In fact, you'll see things, for example, the past 4 years. Real estate has been a boomerang. It's been at the very bottom, the very top, the very bottom, the very top. So trying to pick what's hot today may not play out well for you tomorrow. As part of our investment approach, we really believe in focusing on the bottom line, and that is impacted by fees and taxes. So it's always important to look at, are you maximizing the amount that you keep at the end of the day? And then we truly also believe in rebalancing. That, as I said, when the markets are high and your stocks are soaring, you don't want to get too greedy. It's important to take some gravy off the table. And then again, when the markets dip, sometimes it takes a really strong stomach, but it's oftentimes the best time to buy. Just coming back to that, maintaining a long-term outlook, this chart looks at how often the stock market has been positive over different periods of time, ranging from a 1 month duration, 1 year, a 5 year, a 10 year, and a 15-year duration. Admittedly, you don't hit 100% until a 15-year duration, but what you'll see here is that the probability of gaining a positive return is extremely high, and the importance of maintaining that long-term outlook and not selling out when things may not be pretty, because staying in and having that long-term focus really does pay off for investors. So I hope that what we've gone over has been informative. Welcome you to submit any questions. We're happy to speak to them. This webinar is about you. And just as a reminder, you can submit any questions through the Q&A button on your screen.
Okay, I do have a question. This is a question for Eric. The last 6 months of inflation have been sticky. Is there a thought in the investment community that eventually unemployment will necessarily have to rise to suppress inflation?
Thanks, Kathy. That's a great question. You know, I'll say more of an economic question than an investment specific question. But, you know, as I showed in the slide before, it's very unusual historically for inflation to fall as much as it has without at least some rise in unemployment. There's not necessarily a corresponding one-for-one level that inflation or unemployment has to rise to in order for inflation to fall. And I think what's been interesting is that we've actually seen, again, inflation fall from 9% to a little over 3% without having the unemployment figure increase. I think at some point you'll likely see it, but I think what the Fed and others are trying to understand is how much of what's happening with inflation and the Fed and interest rates is really, you know, sort of post-COVID and in a world that's different from every other type of experience we've ever had with inflation and unemployment. So I think there's still more that people are trying to understand regarding it, but I wouldn't be necessarily surprised to at least see some uptick in unemployment if we want to see inflation come down, continue to that 2% level that the Fed is looking for.
Okay, I have another question for you. Why are housing prices staying so strong when interest rates are so high?
I'll take that one. It's a great question because obviously higher mortgage rates make mortgage payments higher, which makes housing more unaffordable versus more affordable. The problem in the current environment is, again, we had rock bottom interest rates during COVID, and almost the whole world refinanced their mortgage at that time. And many homeowners are sitting with mortgage rates, you know, in the mid 2% range to 3% range. The problem is, unless somebody is looking to sell their house and buy something new with cash, if they're looking to buy with a mortgage, it is oftentimes far too expensive to move from the current house with a low interest rate to another house with a high interest rate. In fact, some people are looking at downsizing. You know, you might be moving from a 5-bedroom house to, you know, a smaller, you know, condo. But interestingly enough, your mortgage might be smaller, the total amount of borrowing that you're looking at, but the payment might be the same or higher. So the problem isn't supply and demand. There's just not enough houses on the market, given they don't want to move because they're kind of stuck with their interest rate on their mortgage.
Okay, I've got another question. If the Fed will be cutting rates this year, what does that mean for the interest rate on my savings account? And what other alternatives do I have for earning money without taking a lot of risk?
I'll take that one, Jen. So if we do see the Fed decrease interest rates this year, you'll see likely and probably very quickly a corresponding decrease in interest rates in things like CDs, money market accounts, and even treasuries. So, you know, if you think about what happened even when the Fed was increasing rates, you saw the increase in your interest rates in those same vehicles. If the Fed decreases rates, you'll also see a decrease. So, it's one of those things where if you want to lock in some of those higher rates today, you could buy a longer term CD. You could buy, a treasury that goes out, 1 year or 2 years, for example. But, working with Jen and her team, you also want to make sure that any liquidity needs you have are also being met. You don't want to be in a situation where you've put some money into a 1 year CD, but you actually need the money in 6 months. So marrying your liquidity needs and your time frame is going to be very important. But there is one way, that is one way to sort of increase your rate and have it sort of locked in for a period of time if you are concerned about interest rates decreasing in the next year.
That is everything that I have.
Okay. Well, thank you to everyone for joining us. We will have a recording of this available on our website. So if you know somebody who you think might benefit or be interested in watching, it will be available. And we thank you for joining us. Have a good day.